Hey everybody, FeedbackWrench here, and what we do is we help inspire entrepreneurship. We help you keep more of your money. We want to help you build wealth, and this channel is all about entrepreneurship, side hustles, and how do you keep more of your money. And today I want to talk about, if you're a freelancer, how do you save massive amounts of taxes? If you're a freelancer, if you do Upwork, if you're a photographer, a writer, whatever it is, if you're earning side gig income, which you should be doing, and you should be pursuing that hard, what are the biggest tax write-offs and tax deductions, right? And I just want to frame this up real quick. I started and founded a tax firm here in Lakeville, Minnesota. They did a good job, and we had a ton of success. But my specialty is helping people understand how to build wealth in the most tax-efficient way. And now I run a digital marketing firm and I do consulting, right? So here's what you need to know. Now, if you do side gig income, or if you're a freelancer, you're earning what's called 1099, or if you're just a small business and you're billing your clients, the first thing you need to remember is that you're not like a typical employee, right? When you work for a corporation, you go work for Target. You know, I'm in Minnesota here. Target's a big company. They're going to essentially, when they hand you $100 or they hand you your wages, the first thing they're doing is they're paying and helping you pay. They pay one half and you pay the other half of your Social Security and your Medicare taxes. Those two together would equal 15.3% on the first $128,000 or whatever that number is of wages. You would pay 7.65%, and your employer would pay 7.65%. Those are the first taxes. And then after that, you would be paying your federal income taxes on your personal tax return, right? So you work for them, they're paying your Social Security taxes, they're actually kind of filing that return for you. And then when you get your wages on your personal tax return, you have to pay your federal income tax. And then if you live in a state like Minnesota, or anybody except for Arizona and Florida and some of these South Dakota, you're gonna pay state income taxes, right? And the thing to know is that that's kind of all pretty simple. But when you start earning 1099 income, now it's your job to pay the self-employment taxes, which is 15.3%, on the net profits, basically whatever you end up making on your income. So it's a little more complex. You just need to know you need to be saving up a little bit more in taxes than you would have in a regular W-2. But here's the deal. When you have this kind of income, there's all sorts of great tax planning things that you can do that your traditional employees can not do, right? So even if you, now just so you know, if you're working for another corporation while you're doing your side gig, if your income is really high, there's some additional rules that are going to apply that make things complex. If you're maxing out 401k plans, if you just have another full-time job, you're going to want to talk to a tax professional. The folks at Xendoo, Xendoo, check out the link in the description. I'd really appreciate it if you'd use that link. We get little spiffs. I'm just totally pushing them because they're amazing. But they can do your bookkeeping, your taxes and everything for that, but they'll help you understand what it means if you have this full-time job. So that's all I want you to know right off the bat. If you have a normal full-time job, which you probably do, that might limit some of the things you can do within this business, tax planning advice, but just keep that in mind. But if you're in 1099 or if you're doing this side gig, here's the deal, okay? There's some really core things that you should know. Now, there's two classes, I would say, when it comes to side gig income, 1099 freelancer income. You have, under $30,000 and then above $30,000 or $40,000. Okay, those two buckets are, I know that sounds kind of ridiculous, but there really is a whole other strategy. As soon as you start making north of about $40,000, the number one thing you can do to reduce your taxes is, and this is number one, become an S corporation, an S corp. So watch my videos. There's tons of information on this, but the most basic thing you need to know is right now, 100% of your net profits, you have to pay Social Security, which is 15.3%, or self-employment tax, which is 15.3%, which is your Social Security and Medicare, and then you pay state and federal taxes also on everything. That's only up to about $128,000. Now, if you become an S corp, so if you're an LLC or if you're just a regular side hustle person, your tax is a sole proprietor, and that's how you would be taxed. You're going to pay the Social Security taxes after your deductions, and then state and federal. But if you become an S corp, you get to cut that in two parts. You have the payroll, or the salary that you pay yourself, and then you have this dividend or distribution. And just long story short, it helps reduce your self-employment taxes, because the dividend you don't pay self-employment taxes on, okay? I'm telling you, if you are making north of about $40,000, becoming an S corp can drastically, if you're earning $80,000, $150,000, an S corporation can put $10,000 back in your pocket. That's the number one tax write-off that you could be looking at. It's absolutely massive. So keep that in mind. That's the number one thing. Now here's the number two thing that you can do. If you run a side hustle, or if you have this side hustle business or a home-based business, remember that you need to not just be a freelancer. You really need to think like a business. You need to think about, well, you have an office, you have all of these different whether it's technology or internet costs or phone or whatever goes into you pursuing that profit is a write-off, as long as it's within the tax code, right? So as a business, did you know that if you stay a sole proprietor, you don't become an S corp, you can hire your kids that are about between the ages 7 and 18. Now there's some books out there that explain this. One of them would be this How to Lower Your Taxes by Sandy Botkin, and he walks through the tax case. I don't want to spend too much time on this, but here's the bottom line. If you have kids under the age of 18, hire them in your business. You need to pay them a reasonable wage for the experience, skills, and type of work that you're doing. So you should find out, what would you hire an adult to do it, and then you would reduce that, because obviously they have no experience. The work needs to be bona fide and legitimate. It doesn't apply if you're an S corporation or if you're incorporated, but if you own property and you have a Schedule E, or if you're just this regular Schedule C sole proprietor, you hire your kids, and here's what happens. Everybody under the age of 18 working in a home-based business you don't have to pay Social Security taxes on their wages. That's sweet. Besides that, remember that the first $12,000 that they earn, that's the standard deduction here this year. Up to the standard deduction, they don't pay any taxes on. So that's tax-free. So right off the bat, you can pay your kids. They don't pay Social Security taxes on it. And then the first, up to the standard deduction, $12,000 is tax-free. And after that, up to $9,525 right now, the next bracket, it's the 10% tax bracket. So you can pay somebody a ton, up to 20 some odd thousand, and only the last $9,525 would be subject to a 10% tax. That's not very much. And then you have state if you live in a taxable state. But that's a huge thing you can do. You can have 3-4 kids working in your business. And here's to top it off. Not only that, but you can actually then have them invest in a Roth IRA up to $5,500 or up to the 100% of their income, right? You can't save more than what you actually make, but you can start these guys investing at a young age. And here's a little tip. I'm going to be doing this for my kids. I'm going to be starting a fund, and it's all about Roth IRAs or an investment account, A, but B, saving up so that they could buy a small multifamily home when it's time for them to do a townhome or live somewhere. And we're going to operate that like a business. And by buying a duplex, triplex, or quad, boy, that is one of the best ways you can get into entrepreneurship. That's just what I'm doing for my kids. But that's the second thing. You can hire your kids and save a ton in taxes. Here's the third thing. Now, this is applicable whether you're an S corp or a sole proprietor, Schedule C. But you could look at these retirement plans and do some deductions. So even if you have just a little bit of side gig income, remember that income is one of the most tax efficient that you can invest. And you'd want to look at not your normal traditional IRAs or Roth IRAs. You want to be looking at the retirement plan versions, which the best ones, if it's just you or you and your kids, if it's just you doing this, a SEP IRA, SEP IRA, or you could look at what's called an individual K or an individual 401k. Vanguard.com. Now I don't have any affiliation with them, and I'm not giving you official investment advice. I don't want to have regulators down my back, but an individual 401k or these solo 401ks are amazing. Now, you can't have any non-family member employees. You can't have statutory employees to have this solo 401k. But if you do this, on the solo 401k and the SEP IRA, you can take up to, I think it's $25,000 or 25% of either your Schedule C or of your payroll, if you're an S Corp, the payroll amount you're giving yourself, and do what's called an employer contribution. So on the SEP IRA, all you have is this up to 25%. You can do whatever percentage of your Schedule C, and then on an S Corp, you have up to 25% of your payroll you can do for the SEP IRA. Now, the individual 401k, I don't want to get confusing here. The individual 401k or the solo 401k is just like that. You can do up to 25% of your Schedule C or of your payroll, and then you can do a regular 401k contribution. And a regular 401k contribution is up to $18,000 or up to 100% of your wages up to $18,000. So basically, it's like you're working at a normal company. Now, that side, the employee side, not the employer, but the employee side, is coming out of after Social Security wages, whereas the employer side is this, it's a direct write-off within the business. It's essentially, in a way, avoiding self-employment taxes, or it's just a very tax-efficient investment you can make. There's more to that, but I'm just trying to keep this simple for people. But then this employee side, you can do either Roth or traditional. So let's just say you made $20,000, $25,000. You can do up to $18,000 if you're under the age of 50. And doggone it, it could all be Roth if you wanted it to. And that means it's not reducing your taxes in this year, but it's tax deferred later. So that would be the third thing. Number one, become an S Corp. Number two, if you're not a corporation, hire your kids under the age of 18. Number three, look at retirement plans. Those are the absolute three biggest write-offs that you can do. If you're just doing side gig work and you don't have a ton of income, what I would do is open up a SEP IRA. That's really simple. And I would make sure that I'm putting in up to 25%. That's a 25% deduction of your business income. That can be really easy.